The investment landscape of 2024 looks promising despite market fluctuations. However, adherence to past market trends can spell disaster. This year, prioritize long-term growth strategies to reap the benefits of your hard-earned money. These investment strategies include value investing, growth investing, momentum investing, and dollar-cost averaging. Each strategy caters to different investor preferences and market conditions. 1. Reduce debt. With so many different investment strategies out there, from simplistic learn this one trick pop investing books to dense tomes by financial doctorates filled with statistical tests of long-term financial data, it's easy for aspiring investors to feel overwhelmed. However, a few key strategies can help beginners lay a foundation for a more successful financial future. Start by reducing your debt. Then, as you save money, invest it in high-quality assets that can grow over time, such as stocks, bonds, and real estate. Finally, consider automating your savings, investments, and bill payments. This could help you eliminate the hassle of manually managing your finances, and it could ensure consistent progress toward your wealth-building goals. Taking on too much debt can significantly slow down your investment journey. It's also a good idea to prioritize paying off the highest interest debt first, such as credit card balances. This strategy is called the avalanche method, and it's a smart way to maximize your interest savings. Growth stocks tend to do better during periods of falling interest rates as companies find it easier to borrow to expand. But be careful not to chase the Goliaths of the market. These heavy hitters often trade at a premium to their historical earnings ratios. Instead, Colano recommends targeting mid- and small-cap stocks to unlock growth opportunities. Investors can find a range of low-cost global index funds to build an efficient portfolio that can match their risk tolerance and investment goals. And if you're on a tight budget, dollar-cost averaging can be an effective way to build your portfolio with a smaller initial investment. By investing a fixed amount of money on a regular basis, you can take advantage of market fluctuations without the pressure of trying to perfectly time the markets. Chapter 2, Invest in Global Index Funds. Index funds are a popular way for investors to diversify their portfolio and lower their risk. They track market cap weighted equity indexes and have the lowest fees of any investment option. These funds also give you the potential for higher dividend yields depending on the stocks they track. However, they aren't without drawbacks. Since they passively follow a market, they can often fall behind during a bull market and are subject to the same market swings as individual stocks. Additionally, they may miss opportunities to benefit from outsized gains in specific sectors or regions. But there are ways to overcome these shortcomings. One strategy is to use a technique called direct indexing, which allows you to replicate an index directly by purchasing the stocks that make up the index. This can help you emphasize or de-emphasize certain sectors while also saving on management costs and tax losses. Another way to diversify your portfolio is to use exchange-traded funds or mutual funds that invest in global markets. This gives you exposure to foreign stocks, bonds, real estate, and even hard assets like gold or silver. Additionally, these funds can lower your overall cost, helping you keep more of your investment returns. Finally, it's a good idea to beef up your fixed income holdings in 2024 by investing in short-term corporate bonds. These securities offer higher yields than traditional T-bills and are less volatile than stocks, making them a good hedge against wild market fluctuations. Additionally, many short-term corporate bonds pay out regular quarterly dividends. These dividends can boost your current income and help offset the impact of a decline in stocks. Chapter 3, Diversify your portfolio. Diversified portfolio is an essential part of building your financial future. Whether you invest in stocks, bonds, or mutual funds, diversification is key to keeping your wealth protected from market volatility and allowing for the potential of long-term growth. By balancing lower-risk assets like bonds with higher-risk investments like stocks, you can reduce overall risk while still maximizing the opportunity for returns. The first step in determining how to diversify your portfolio is understanding your investment goals and risk tolerance. And once you understand these factors, you can make the best decisions about where to put your money. In general, experts recommend dividing your investments into several asset classes to minimize risk. This includes a mix of stocks, bonds, and real estate investment trusts, REITs. Additionally, you can further diversify your portfolio by diversifying within each asset class. For example, you can diversify your stocks by market capitalization, small, medium, and assets, and large caps, sector, and geography. This helps to ensure that no one area of the market is disproportionately affected by any given economic cycle. You can also diversify your bond holdings by investing in a variety of different maturities, credit qualities, and durations to avoid overexposure to interest rates. This is important because as rates rise, bond prices tend to decline. Once you have a balanced, diversified portfolio, it's important to maintain this allocation over time. During strong market periods, the equity portion of your portfolio may grow larger than expected, but as a result, it's important to regularly rebalance your portfolio by shifting earnings into the other portions of your portfolio that have been underperforming. This process of rebalancing will help you stay on track with your long-term savings and investment goals. Chapter 4. Invest in healthcare technology. Investing in healthcare technology is an excellent way to build a better financial future. Investing in the right technology can help your practice improve patient and staff satisfaction while also meeting industry demands. But you should carefully consider the potential risks before making a decision. The healthcare sector is highly regulated and investments can be volatile. For example, clinical trial results can significantly impact stock prices in a short amount of time. This is because the success of a new medicine or device can greatly increase revenue for healthcare companies. Additionally, changes in government regulations can have a significant impact on the sector as a whole. It's important to monitor regulatory bodies, such as the House Ways and Means Committee, to ensure they are not passing any bills that would negatively affect healthcare companies. In addition, healthcare tech companies must develop and implement solutions that are cost-effective and easy to integrate into existing systems. They must also provide reliable cybersecurity, because cyber attacks can compromise patient data, hurt a company's image, and lead to financial loss and non-compliance fines. To make the most of your investment, look for companies that have strong revenue growth prospects and a history of delivering on their promises. You should also consider the size of a company's market opportunity and how much potential it has to grow. Lastly, be sure to evaluate a company's competition and its market share. If a company has poor market share, it may not be able to maintain its current growth rates in the future. Jam Tobe is a writer for NerdWallet who covers investing and personal finance news. He has a bachelor's degree in economics. 5. Leverage digital currencies. If you're interested in making high profits with minimal investment capital, leverage trading crypto can help you do just that. This form of digital currency investing involves borrowing money to increase the buying power of your transactions. However, it's important to remember that leverage trading is risky and you should only use it if you have the proper knowledge and experience. For the best returns, you need to choose the right strategies for your unique financial situation. By avoiding impulsive decisions, you can develop a personalized investment strategy that aligns with your risk tolerance and financial goals. This is the best way to ensure that your investments will generate a healthy return over time. Investing in real estate investment trusts, REITs, can be a great way to diversify your portfolio and earn solid dividends. In addition, REITs are often tax efficient and offer low risk, compared to individual stocks. If you're looking for stable and consistent returns, consider adding REITs to your portfolio in 2024. Another great investment strategy is to follow a momentum-based approach. This type of investing requires you to be actively monitoring the market for opportunities to buy and sell at opportune moments, which can increase your profit potential. Momentum-based strategies are often implemented using ETFs, but they can be challenging to master as you need to know when to enter and exit the market. Lastly, you should consider beefing up your fixed income allocation by investing in short-term corporate bonds. These securities provide higher yields than T-bills and are less volatile than stock markets. Furthermore, they can reduce the overall risk of your portfolio by cushioning any losses during a recession. However, be careful to choose a bond fund that is appropriate for your risk tolerance and investment goals.